Vinay Sharma joins us now. Let's take a conversation forward. Let's understand what he makes of the banking sector and where dynamics are going. Vinay, there is enough and more which has been discussed why there is value in the private banks. But I have a very contra view. I always say that markets are supreme. And it's only in hindsight we figure out that this was right and this was wrong. So the fact that banks are underperforming, are markets telling you that there is something happening in banks which we'll only figure it out in next couple of quarters? It could be on NPA front, it could be on the NIM front, it could be on the regulatory front.
Yeah, good morning, Nikunj. Nikunj, no, see, our opinion is we continue to like banks, particularly the large banks and also mid-sized banks at this point of time. Because the way we analyze markets and economy at this point of time and the sector, we don't see any immediate risk of a credit quality cycle. You can see across the board consumption is doing well, real estate is doing well, which is basically you understand that real estate is the collateral of most of the loans in India. So property doing well itself gives a lot of stability to credit cycle. There have been some tidbits, and RBI has taken some action on personal loan space, and we have heard some deterioration in less than 50,000 sort of loans or very small personal ticket size loans. We have heard that cycle might be turning a little bit, but that space is so small in the overall context of banking system that at this point of time we are not worried yet. I heard one of your earlier participants that uh, sort of margin seems to be bottoming out, and we don't see there'll be a major impact on growth because of any of either RBI measures or because of any economic conditions in India. So we expect growth to be in mid-teens for the banking system going in the next 1 or 2 years. And frankly, they have underperformed a lot. Their valuations today are lesser than the market, lesser than their historical averages. Um, what we believe is they are lesser than what the fundamentals deserve at this point of time. So, from an overall point of view, we continue to remain sanguine on the Indian banking system at this point of time.
Um, Vinay, another technical fact is that everybody is overweight banks. I mean, I'm yet to find a bear in HDFC Bank. I'm yet to find somebody who says that banks are not cheap. So where will the fresh buying come from?
So, Nikunj, frankly, that is not part of my job. Like, we worry more about fundamentals than some of these technical factors when we are looking at markets. So, for me, what's important is yes, FII flows have been muted, and yes, banks are part of almost everyone's portfolio at this point of time. But just to comment on your question, once the FII flows come back, and emerging market situation is looking a little better for next year. Dollar index seems to be picking out. US interest rates seems to be picking out. Generally, the expected recession in US, the general consensus is it's going to be shallow and not a very sort of long recession. That combined with interest rates coming down, we could see a decent time for emerging markets to come, because emerging market fundamentals don't see are not seeing any deterioration at this point of time. So I think that could change the flow perspective in banks, but frankly, we are not worried about that. As long as fundamentals remain good, money will find its way.
Fair enough. What about the outlook then when it comes to NBFCs, given that the risk weight is now about 20% and we're at about 45%, more than 100% increase? Would that not mean that banks as well who have exposure to NBFCs of AAA will see much of an impact?
So yeah, that point is correct. There will be some pricing pressure in the entire system. Cost of funds will go up for a lot of NBFCs. We would not like to brush all NBFCs here, because some things like housing finance and some of the other segments don't are not impacted by the recent measures. But overall, yes, I think cost of personal loans in the system will go up. But in a way, that's good for the system, right? Because that one, it sort of reduces the exuberance in the market. I think central bankers and regulators would be worried about the kind of activity that's going on in stock markets and land prices in India, and therefore some of this would be reaction to that also. To sort of, because the end use of personal loans sometimes is not very clear even to the banks. So I guess it's a mix of over exuberance in credit, plus a little bit of over exuberance in asset markets in India. But frankly, that's good for the system because one, it brings the pricing discipline back, and obviously banks and NBFCs would be more judicious going forward on the RBI nudge. So yeah, that's about it. I don't think this will have a major implication for the system as of yet.
Uh, if this entire unsecured loan category, let's say, hunkers down, or Reserve Bank of India forces NBFCs and banks to hunker down growth by 10 to 15%, what to your mind could be the incremental impact on credit growth and spreads?
So, Nikunj, when it comes to spreads, obviously this will have a neutrally sort of impact because, as I said, the pricing discipline will come back. So therefore, spreads will go up, whereas the volume will come down. So I think these two factors will tend to cancel each other out, and from a spread perspective, it should not have a major impact on the system. Obviously, growth will go down a notch because we have seen uh, these personal loans going at mid-teens to close to 20% levels for a fairly long period of time, and I think that figure will now come down by a few percentage points. But from on the other way around, I think capex cycle is picking up. A lot of manufacturing excitement is there in India. A lot of sectors, including as I said, property is are there's new investment coming up, and there is activity in the market and fairly decent activity. So to that extent, I think there will be some mitigations, even if personal loans go down a little bit in terms of growth. But yeah, from an overall perspective, I think these measures could shave off 2-3% growth from the banking system.
To have you on board. Thanks so much for taking time out, Vinay, and sharing with us the entire outlook on the banking sphere.